Hey everyone, and welcome back. One of my favorite things to do while in the finance space is to keep up to date with what Michael Burry is saying on Twitter, because man, that man is hilarious. He goes on these Twitter storms. It seems like he might black out for like 48 hours and then he tweets a bunch of stuff. He then wakes up and realizes what he's done and he deletes a bunch of tweets. So his Twitter is just an absolute carnage of crazy tweets that he's made for the past 48 hours, and then nothing before that because he goes and deletes all of them. And over the past couple of days has been one of those periods where Michael Burry has gone on a rampage talking about a bunch of different topics, from cryptocurrency to passive index fund investing to his take on the Evergrande situation that's unfolding at the moment in China. So in today's video, I just want to go through some of the tweets that I thought were more interesting and share my thoughts on them, share my take on some of his opinions and what he sees in the markets. If you enjoyed today's video, then I would very much appreciate it if you take the 2 seconds to leave a like on the video and hit subscribe if you want to stay up to date with content that I post in the future. But with that said, let's jump into the video. Since Michael Burry has a habit of deleting tweets immediately after he posts them, or a couple of days after he posts them, and then even shutting down his Twitter account for months and then reopening it later, the way that I'm getting all of these tweets is from a different Twitter account called Michael Burry Archives. And this Twitter account basically just takes all of Michael Burry's tweets and keeps them there forever, right? Even if Michael Burry deletes things, the internet is forever, so we have an archive available to take a look at everything that he has looked at. So if you're ever wondering how I'm able to get these tweets even though they're deleted, I'm not actually sitting there watching his Twitter all day long every second. I'm using something called Michael Burry's Archives, which allows me to see them. The first tweet that I want to talk about from Michael Burry today is one that he posted on the 19th of September. And in this tweet, he talks about how for every $1 that has been invested in the stock market, it has generated a $5 increase in the market value. And he links a research paper to support this finding. He also says that 90% of millennials, aka the future wealth owners, are in passive market vehicles. That 5-to-1 ratio will get much bigger, much sillier in time. COVID didn't stop it. Inflation might not. What Michael Burry is talking about here is how it is super mainstream right now, particularly among young people just getting into investing, to invest through index funds, to just passively invest by buying the entire market. Because if we look at what an index would have done over the past 100 years, say for the S&P 500, which the S&P 500 index has not been around for 100 years. It's only been around for about 20 years. But if you assume or pretend that it did exist for the past 100 years, then you would have made about a 6 to 8% return after inflation if you were investing over any 20, 30 or 40 year period during that time. And what a lot of people have done now, and I'm certainly guilty of this to an extent, is taken that historical data and assumed that that will happen in the future regardless of what price you're buying those index funds at. And the dangerous mindset behind that is it gets very much into the idea that, or many of the ideas that created the housing bubble in 2008, which was that people believed that housing could only go up, that it was super solid, and that it didn't matter what price you paid for your real estate, that you would make money on it. People were buying it with the intention, with the belief that it would just go up, rather than looking at the fundamentals of that property, which would have been what rental yields could it actually generate. And a similar thing is happening in index funds, where you have massive amounts of money from young people particularly flooding into the markets and investing in businesses without considering the price of those businesses, right? And that of course inflates those business prices relative to what those businesses are actually producing on an underlying basis. So while of course it is a great thing that we have these investment vehicles for people to basically invest in the US economy without having to dive into the analysis of individual businesses, it also certainly creates a significant amount of irrational market behavior, because rational market behavior, of course, would be assessing individual businesses, estimating what is reasonable to get out of them in the future, and paying a price based on that. If you're paying for a stock just because you think it will go up, that is irrational. right? You have to compare the price you're paying to the cash flows that the business is producing. And when you're index fund investing, you're just not doing that. Burry goes on to say that the first step is to recognize that 5-to-1 is not a natural ratio. It's a product of a paradigm. So what will continue this paradigm? What may reverse it? This is a knife's edge because we are 5-to-1. It may go to 100-to-1, or it could become -5 to -1, but parabolas don't resolve sideways. And I think this is a really critical thing to understand, right? If it is true that index fund and passive investing, people just investing blindly basically into the markets, if it is true, and it seems to be true, that it is pushing up the market, the value of markets or the value of stocks far higher than the amount of money that is going in, then the same thing could be true on the other side, right? If there is widespread panic and a lot of people are pulling out of passive investments, they're pulling out of index funds, then that's invested dollars coming out of every business, pulling everything down. And it could very well be the case that a similar trend is seen on the downside, that for every dollar that is removed from the market, from a passive investment, for example, that the market value of stocks will go down $5. And that could mean that while the market has gone up at a huge rate over the past few years, an absolute unprecedented rate, the opposite could also happen. We could have an unprecedented decline in stock prices that we've never seen before. So what are my thoughts on this? Well, I do like index funds as a foundation of my portfolio. I keep about 10 to 15% of my portfolio in index funds at all times. So I do like them as a vehicle to invest broadly into the market, but it is certainly not the majority or the most significant way that I invest. The most significant way that I invest is looking at individual businesses where I can assess future cash flows for those businesses and make rational decisions about when I should invest in those companies, when I should hold on to them, and when I should sell them. And if you're interested in learning more about how I do that, then I recommend you check out the free stock analysis playlist on my YouTube channel. 4-Step Stock Analysis is what it's called. And there's about 15 or 20 videos in there that go through how I analyze businesses. If you've already done that, then I would consider checking out Learn by Example as well. I'll link that down in the description below. That's my private investor community where you can work alongside me. So if you want to take it to the next level, you can do that. One other interesting thing that Michael Burry tweeted over the past few days, this one was on the 20th of September, was in regards to how the Federal Reserve is calculating inflation and seemingly using very specific inflation numbers to get the outcome that they want and to be able to talk about inflation in the way that they want. Burry shared a screenshot from a Wall Street Journal article which talked about how Jerome Powell, the head of the Federal Reserve, was using a gauge for inflation that gets rid of the top 31% of the measures and the bottom 24 of the measures, essentially meaning that they are leaning on the downside when showing their figure for inflation. And the outcome for using that figure, where they took out the top 31% factors and the bottom 24, was that the target was exactly 2%. So what Burry is saying here is that it's very, very convenient that they used this measure that removes the 31% of the worst inflation numbers, the highest inflation, but only 24 of the bottom ones, and the outcome was 2%, which is the Fed's target. He thinks it's very, very convenient that they're doing it in this way, and believes that they're trying to downplay inflation, which I think is exactly what they're trying to do. They don't want widespread panic, even if inflation is a little bit higher than 3% and it's not actually too much of a concern. If people know that it's above the target, then people might panic, and that might cause a significant sell-off in the markets. It's no surprise to me at all that the Fed is doing everything in their power to be very, very careful with what they say and what data they release to try and keep fear out of the market while they go through this monetary policy change. Because the reality is they are going to have to start pulling back and tapering and restricting some of their monetary policy, which has been extremely loose, extremely generous to markets over the past 18 months in particular. They're going to start to wind some of that in, and they have to do that while not making the market believe that inflation is overheating and that the economy is overheating, because as soon as that fear starts, can start an avalanche of sell-off that could have a significant impact on the markets. As I said, Michael Burry spoke about a bunch of different things, so I'd highly recommend you check out everything that he is saying. You, of course, don't have to agree with everything he says or even understand everything he says, but it's always interesting to see his perspective on things as an individual that's kind of not, he just says his own opinion, right? He just shares what he believes. So I'd highly recommend you check out more of what he has said. And if you did get some value out of today's video, I would very much appreciate it if you leave a like on the video and hit subscribe if you want to stay up to date with content that I post in the future. But with that said, hope you guys have a great day, and I'll see you in the next video.